Hey guys, one question that we get all the time when people are getting ready to transition into retirement is which account should be taking money from first? Now, that is an important decision, and before you can go about answering that, there's one thing you have to understand, and that is the main thing that separates all of your different retirement accounts is taxes. That's kind of the common thread here. So the first and foremost thing you need to look at before you start taking money out is what kind of tax impact is taking money from this account going to have on me. It's important to remember that almost every single financial transaction has some sort of tax implication on it. So for retirement accounts, there's typically 3 different ways you're going to be taxed on those. So for your pre-tax accounts, those are accounts like your Plan 3, 403B, and DCP. Those are usually money that you've paid into. You got a tax along the way, but you haven't paid tax on that money yet. So when you take money out of retirement, you're going to have to pay taxes at that time based on whatever tax rates are at. Money that's tax-free, mainly these are going to be your Roth accounts, so Roth IRA, the Roth DCP, Roth 403B. You've already paid the taxes when you put the money in, so therefore that money can come out tax-free. And then if you have investment accounts, so you open up an account through Robinhood, or maybe your advisor has you set up somewhere, and you have stocks or bonds or whatever in these accounts, the way these are taxed is you've already paid taxes when you put the money in initially, so you only owe taxes on the gains. So depending on how long you've held the investment inside the account, you're going to pay either a short-term gains rate, which is the same as your ordinary income bracket, or you're going to pay a long-term gain rate. So if you held the investment for less than a year, it's considered short-term. You pay ordinary income taxes. It's just the same taxes that you paid on all of your income from your pension and your pre-tax accounts. It's that same tax bracket there. Now, long-term gain rates are more favorable. So typically, the long-term gains rates are usually less than what you pay on ordinary income tax rates. So with that out of the way, the first thing you need to determine is what type of accounts you have and which bucket they fall into. Once you have all that organized, understand the tax implications of them, the next thing to do is look at your own situation and determine, does it make sense for me to take money out of pre-tax this year, or should I take it from tax-free, or from my brokerage account, or maybe a little bit of both. So you need to look at what tax rate you're currently in, and as well as being aware of what we call shadow taxes. So shadow taxes are kind of little taxes or payment increases that can be triggered if you have too much income. So for example, the way Social Security tax is based on your provisional income. If I take money out of a pre-tax retirement account, that increases my provisional income, and then more of my Social Security benefit is now subject to taxes, which means I'm going to get less from Social Security. Same thing if you're doing Medicare. There are Medicare surcharges. So if you have too much income and you go over by just $1, you and your spouse now have to pay higher premiums on your Medicare for the next year. So it's important to keep those kind of things in mind before you start just taking money out of pre-tax accounts, because there can be more tax implications than you initially realize. So now back to the question, which account should I take from first? So if we're in a tax environment, it's kind of like today, where taxes are fairly low for the most part, and we think maybe they're going to go up, in that case, I'm probably going to take more money out from my pre-tax accounts. I'm going to take money out of these accounts because I want to pay taxes while they are low. If I think taxes are going to be going up, I want to take every advantage of this right now. Now, if taxes are higher in the future, maybe I'm going to switch. Maybe I'll take a little bit less from these pre-tax accounts, and maybe I'm going to tap more into my tax-free accounts, my Roth, so I can avoid paying taxes at such a higher rate. And maybe I'm going to wait until taxes come down. So when you have money set up in these different areas, it kind of allows you to manipulate your taxes, so to speak. Legally, of course. So if taxes are low like they are now, let's say they're at 20%, maybe we take all our money out from pre-tax accounts. If taxes go up to 50%, I want to pay 50%, I'm going to take money out of my tax-free account, or maybe I'll just take money out of my brokerage account. So taxes are a really good way to determine which account you should be taking money from first. Now, if you are going through retirement and all your money is just in one place, so you only have money in Plan 3 or you have money in Plan 3 DCP, then all your money is in just one bucket, there's not really much you can do. So in that case, you only have one way to take money out, but it's not too late to plan yet. You can still set up something like a Roth IRA and do Roth conversions into it, so you can actually have at least 2 buckets, a pre-tax and a tax-free one, so then you can pick and choose in the future where you want your money to come from, and they can help you with your taxes in the long run. Now, if trying to figure out all this tax stuff sounds way overwhelming, it's okay. This isn't your realm of expertise. That's what they have financial advisors and CPAs out there for. You can consult one of them to help you through it and make these decisions. It's just like getting your hair cut. We all have the ability to cut our own hair, but we all know that it's probably going to come out much better if we just go to a professional and pay them to do it and make sure it comes out correctly. Your finances and your life savings is no different. You want to make sure things come out well, go to a professional, pay them for their time, and then you stand a much better chance to have things work out in your favor. So now if you're looking for a professional that specializes in Washington State employees, that's what we do here at Scenic Financial. All you have to do is book in a call with us using the link below, and we're happy to set up a time to talk. We also review tax returns to make sure that when we give advice, we know full well of what the tax implications are on you before we make them. When we approach financial planning this way, it allows us to make much smarter decisions that are in your best interest. So if you'd like to set up a time with us, that link is in the description below. I'll see you guys next week. Remember that your future depends on what you do today.